Good afternoon, ladies and gentlemen. Let me just start. So basically, over the next 20 minutes, I'll try to basically, touch on the key points so that you all can decide whether or not there's future investing in Chinese equities. But before I go into the proper presentation, I just want to maybe, touch on give me maybe 2 minutes to touch on a bit on geopolitics, especially, when it comes to investing in Chinese equities right now, you have to also consider geopolitics. And in geopolitics, I just want to highlight to everyone is that there's actually no right or wrong. There's no such thing as divine or evil. Countries, the presidents or the prime minister, the leaders of the countries basically will act in the interests of their people. So, in a democratic countries like Singapore, for example, leaders are selected, elected, and they basically, will act in the interests of the people. So in the case of what we term as authoritarian or communist system, the leaders are selected. And therefore, you have to understand all this. There's actually nothing wrong between, democratic society or communist society systems. See, ultimately, all these leaders are to act in the interests of the people. So, as you're probably aware, is that, between US and China right now is a struggle of superpowers. And unfortunately, I think in Singapore, we noticed, and also because of our educational background, we use English as our primary language. And therefore, along the way, is that you will be subjected to what I believe as the influence of Western media. And you all should know that of late, especially over the last 3-5 years, the Western media has been very critical of China and the development in China. So again, these are the backdrop so that as I go through this, you all can at least understand. So what you see here is the chart. Basically, China had a fairly strong, I think, very strong years even during the COVID period. If the Western media is to say is that China probably underreported their number of deaths. But what happens here is that what I believe, if you look at all the data available, is that actually China has actually managed the COVID crisis pretty well. But what happened last year was that China decided to sacrifice its economy to save people, and therefore had implemented what we term as lockdowns that is actually very surprised. Lockdowns in Shanghai, in Shenzhen, that actually caused the economy to be slower. So last year, China only grew 3%. The year before that was 8.4%. So along the way, the Chinese market, as you can see on the chart, rose back in 2020. But in 2021, what also happened was that, they did what we term as, they call it a drive towards common prosperity. And they had a bit of regulatory crackdown against very large mega cap e-commerce companies. But nevertheless, what happened is that, since then, I think especially last year, things were not turning out to be very good for China. But then what happened is that as we look forward for this year was that this is the reopening that we all has been anxiously waiting. I think Singapore has reopened for business. Life is back to normal. We don't really need to wear masks. Even you contracted COVID, you just rest for a week and then you recover again. But the case here is that I think when China reopens, it's a very big thing. And therefore, if you look on the chart here, is that they actually recovered pretty strongly as the whole world anticipates China to recover economically. But however, due to the balloon incident back at the beginning of February, so things turned to be very negative again. And all this negativity is due to, if all this Western media narrative that China basically sent a spy balloon to spy on US. So again, these are all politics. Whether it's a spy balloon, weather balloon, actually doesn't matter right now because, the point is that if USA is a spy balloon, meaning that, investors will feel a bit of tension between the two countries going forward. Okay, maybe I should tell you the key thing about this recovery is that I think things are actually turning pretty well for China economically. If you look at some of the reports during their May Day Golden Week holidays, you can see that it was reported that 240 million people actually travel internally. You imagine 240 million, I think Singapore is only 5-6 million. When 240 million travel internally, and each of them spend $100 over 5 days, which is a very small amount. We are talking about $24 billion. So you say 100 is not enough, spend 200. So we are talking about almost like $50 billion over the Golden Week holidays in China. So again, this year, while the global economy, as you probably have some sessions before this, is that the external demand are likely to be weak. Like Singapore NODX is falling. It symbolizes the external demand because of very sharp slowdown in US, in Europe. Therefore, exports are likely to be negatively impacted. And therefore, you have to basically rely on certain things like, for example, your own domestic demand. So in this case, China is pretty strong in this area. So the point here is that we also show you the PMI. There's a big recovery and basically led by what we term as the non-manufacturing PMI, which is the service PMI. The service PMI basically means that you must understand that last year, on a low base comparison, China was subjected to a lot of lockdowns. This year, there's nothing. You are free to go, life is back to normal, and then you have all this revenge kind of spending. And therefore, you can see that, China is clearly turning around. Although, again, I want to highlight to you all is that just look at the data. Don't be affected by news flow to say that, China's growth is not that strong or weak. Okay, the government actually came out to give their guidance that GDP growth will be like around 5%. By the way, Goldman Sachs reported that, anticipate that the growth is likely to be around 6% for 2023. China grew 4.5% Q1, okay? In order that China at least reach 6%, Q2, Q3 are likely to be even more than 5%. Else they cannot reach their minimum target 5%. And 5% is just the government's target. There are other economies worldwide are actually raising a higher number. Of course, at the backdrop, you also have to understand that this year, Europe is likely to go into a recession. And that US Fed has increased interest rates to 5.25. With higher interest rates, surely there will be economic slowdown. So it's inevitable. And therefore, you have to basically understand, for China going to this year, they have to depend a lot more on domestic consumption. Of course, here is that, this is really geopolitics, is that why investors are also concerned in the case that, this US-China tech war, this is following the, US-China trade war back in 2018. In the trade war, I can highlight to everyone is that China actually is winning in terms of the trade war. Why? Because China's, if you look at the last year's trade numbers between US and China alone, it was a record trade numbers exports for China, trade deficits between US and China. So therefore, even despite the tariff, where I think importers have to import and pay tariff around 20 to 30%. But so despite that, China is still able to sell a lot more goods to the US. However, given that US need to understand that in order to suppress China from growing even further, they have to come up with certain things to basically suppress China. And, maybe I want to give example. I think maybe some of you are born during that time, is that during the 1980s, 1985, Japan was supposed to be a very strong economy. If you all know, Japan, the likes of all the Japan corporates, they are very strong in semiconductors. Their automobiles are also very strong. Your Toyota, your Mazda, for example. Your semiconductors, your Toshiba, Hitachi. Even Sony at that time was a very strong, consumer electronics. By 1985, if you all can read up also, is that US actually activated or implemented what we term as a semiconductor constraint on Japanese product. And therefore, and also with the Plaza Accord back in 1986 was that they raised they appreciate the currency of Japanese yen, make it very uncompetitive for Japanese export. And therefore, the Japan economy since then, of course there were other problems thereafter, but since then have 20 years of, basically, what we term as the lost 2 decade of depression. That is the backdrop. And basically, US is implementing the US CHIP Act, the US CHIP 4 Alliance to basically corner China. Again, it's a lot of things, moving parts, is that China doesn't fear competition. But this is basically not really competition in the sense that, if you look at Intel can manufacture 7 nanometer advanced chips. SMIC recently announced that they can commercially manufacture 7 nanometer. But the point here is that, US will basically invoke this and basically, ensure that, other players, whether is it Samsung or TSMC, in this case, TSMC already doing 5 nanometer, going to 3 nanometer, are not able to supply advanced chips to China. So in that sense, trying to suppress China. Not only that, is that US also get or ensure that their alliance, in Europe, for example, as ASML, in Netherlands, not to supply lithography machines, to China. So basically, China has to do everything, and need to be very self-reliant on itself at every level of the semiconductor supply chain. And it's going to be, of course, a challenging task. I'm not saying that China cannot overcome it, but China needs time to overcome all this, Okay, again here is that a bit of backdrop. Why US is doing this? US is very happy when China just do the normal parts, earn the normal business. China rose, especially after WTO, start to gain a lot of momentum. If you all notice of late is that actually, in terms of quality of goods, China is actually getting a lot stronger. It's no longer the weak, no longer doing toys, for example, or make low margins. So Chinese also wants to gain more margin and move up the ladder curve. But what shocked US was that China is doing 5G with Huawei. This high margin business, this is what the Western wants to dominate. Chinese shouldn't be doing all this. Chinese should do the low end stuff. So Therefore, you have all this problem right now. And, the point is that with 5G, 6Gs, and China moving to EVs, AI, quantum computing, that makes US pretty nervous. because we are talking about hegemony status right now. And therefore, this is not like, this situation will go to end in the next 5 years. It's going to be next 5 years, 10 years. Unlike the Western economies, China does not have an inflation problem. So inflation is still pretty benign in China. So, it's, again, here you have to understand is that while last year reported was that, because of fuel shortage, a high oil price, because of some commodities, for example, inflation shot up the roof, So we are talking about, inflation in US, now of course it's coming down, but in Europe, we are talking about high numbers between 6 to 10%. But in China, we are talking about very mild inflation. The last one was just 1.8%. So in that sense is that I felt, and China can actually afford to reduce interest rates or adopt a fairly competitive, monetary policy. So this is actually a very different from the Western economy. However, of course, here is that I think investors or you all should also read that, China did have some problems because of, some very highly leveraged property developer going to financial difficulties. But what happens last year, back in November, is that the Chinese government actually came up with a 16-point plan to try to at least ensure a soft landing for its property sector. The point here is that, this takes time because what happens is that there were some issues where some of these home buyer who doesn't want to serve mortgage loans, basically stop paying mortgages. But what happened is that their complaint was that the units wasn't even built or not even building. I won't want to pay for it. See, so the government basically now have to take over the construction part of it, to oversee it, to ensure that all these units are completed, and therefore allows the home buyers to continue service their mortgage loans. And once that is done, I think basically the completion will take at least a year. So we are actually like few months down already, since 6 months already. So maybe by the end of this year, at least some positive sign from there. So bear in mind, unlike the Western economy, China interest rates remain low. So therefore, affordability of home buyer are basically not really affected. So that is the distinction I just want to highlight to everyone. Okay, but since then, if you look at the valuation of China equities, is that unlike in US or some of the Western economies, Chinese market is still fairly depressed. I will attribute that to what I term as highlighted on the very first few minutes of my presentation, is that there's geopolitics involved. So, the point here is that I think we all can read. I think most of the audience here can read English, can even listen to Chinese, for example. But unfortunately, a lot of Western fund managers only have one channel of news flow, and that's through Western media. And therefore, you can imagine that their understanding may be also very subjected to all this news flow. Maybe I just want to highlight to everyone is that let's look at China at itself and what is its strength. If you look at this, what we term as a 1 trillion global economy, China is the second largest as shown in the chart here. But again, I want to highlight to everyone, while China is the second largest economy in the world, is the top exporter and importer of goods. So, the point here I want to highlight here is that the other thing is that, China has the largest middle income consumer market in the world. Why? Just give you an example. How many cars are sold in US? We are talking about 15 million cars a year. But in China, we are talking about 25 million cars a year. So China has actually overtaken in terms of the size of the market. And, a lot of MNCs basically also want to participate. and want to do business with China. So we all read on the news media is that, hey, who is visiting, like French president is visiting China. Basically, they just want to do business with China. China has proven capability. And of course, here is that, in terms of, China, okay, I just want to highlight here a bit more, is that, this is going to be a transformation change that all of us should be aware. It's just like your iPhone, your smartphone back in 2006, when feature phones, your Nokia phones, went to smartphones. Where we are going to face a change is all those industrial combustion engine cars. Combustion engine cars will change to what we term as electric vehicle. And what happens here is that China is very dominant in this area. And even like for example, German automakers wants to partner Chinese battery makers to do all this, to basically produce electric vehicles. And electric vehicles, over the next 10 years will continue to grow very strongly, at least 30% per year. And what I just want to show you is that China basically had this supply chain, basically covered right from the upstream, from the material segment to making cars. And not only that, if you all think about, we are going green, every government is going green. Again, here is that you all need, or the world need, for example, just in solar cell, they are so dominant. If you look through whether China, they basically produce modules, cells, wafer, polysilicon, just dominated. If you look at the red bars over there, is that China basically dominated in those areas. Of course, we talking about consumption. We think that over the last 3 years, they basically, they were in lockdowns and they have accumulated a fair amount of savings. They are likely to spend, and what we term as revenge spending, especially in the first few months of this year. And not only that, I think basically in terms of consumption, they are likely to even spend more, local, even for local brands. So these are some things that we look at, when we invest in China. And although this has been highlighted as aging population, I'm sure, everyone is getting older, by the way. But the point here is that, this is also a situation, an issue for China. That's why China wants more birth, to ensure that at least the population does not decline. But just to highlight here in terms of healthcare expenditure per capita, China is still one of the lowest. And therefore, it is actually a very good opportunity because these are aging population. You have to spend more to tackle these kind of issues. So with that, I just want to highlight here is that, for example, China A shares, I'm not talking about China H shares. China A shares are the lowest in terms of correlation with other markets. So, therefore, I think the trend here is that at least over the next 2-3 years, China A shares are likely to perform better than China H shares, as the reason I've pointed out. And finally, again, what we term as a China equity discount are likely, because of geopolitical situation. And because the West dominates in terms of global financial markets, therefore, as I highlighted to you, some of the Western media reporting matters more, even though that it may not be factually correct. There again, Chinese economy likely to remain strong into this year. We believe that Chinese equities is attractive, but however, because it has to be traded at a discount, do not expect, like 100%, 200% performance, within a short period of time. China, unfortunately, over the next 5 years, we probably should know by then whether China is going to win or to be the largest economy in the world. Because whatever US is trying to suppress China, it all depends whether China can pull out of it. My belief that there are certain issues, but if China, put it that way, China's political system is more stable, in the sense that they don't expect Xi Jinping to be away, at least over not the next 10 years. But however, the next US presidential election are likely to be a bit more complicated, because you don't know whether Biden will continue in the next term or Donald Trump will come back. And these are political uncertainty even for US. But more specifically, there are actually a lot of companies that are trading at what we term as good valuation. The listing of Alibaba units, are likely to be some of the thematic that could be a catalyst for investors looking back at China again. Right now, China just trades at 10 times PE. This includes the Hong Kong, China stocks. And we don't expect it to go to 15 times, unfortunately, but ascribe a lower valuation. But that will also still means some decent upside. But you must understand, every time there's a big upside, please take profits, because at the end of the day, there will be negative news. And once negative news flows, then investors, it's like the Western news will always highlight the negative things about China. No doubt about that. So even 5% growth is considered, when US is growing 1% or 1.6% max, if China grows at 5%, hey, I'm growing 3 times more. But they say 5% is actually very weak. So, but my understanding is that at least China can grow 6% this year. So I believe that, you still can get some upside from there. But the challenge here is that, if you have a longer term investment horizon, I believe that over the next 5 years, China can actually overcome all this suppression, and China will be the largest economy in the world by 2030. And therefore, if you invest in China equities then, or China A shares, you should get actually pretty decent rewards for the risk that you take. Okay, with that, maybe, I run out of my time. If you all need any questions, I can do it during the later Q&A. If not, you can go to the UB Asset Management booth. I'll be there. We can basically discuss any issues that you may have. Thank you very much. Thanks.